First, it was 4% GDP. Now, it's a 4-week losing streak. Will there be a fifth? Let's discuss. My name is Dan Slim, and welcome to another episode of Monday Market Outlook. The longest government shutdown in U.S. history finally ended last week after 43 days when President Trump signed a temporary funding bill to reopen federal agencies, funding most government operations through January 30 of next year. However, the initial good news turned sour as investors realized that they will not be getting their favorite economic indicators. Because the shutdown began in October 1, federal workers were furloughed, meaning from that day forward, no data was collected, verified, processed, or prepared for release. So, as a result, the government had nothing to publish. And while September data was already gathered, no, so the September jobs report will still come out on November 20, but the October report may never be released at all. So the US economy finding itself driving through fog. And what do you do when you're driving in a fog? According to Fed Jerome Powell, you slow down. So investors realized he was serious when he said the December rate cut wasn't in the bag. Market sentiment soared as worries grew that the Federal Reserve could pause not just in December but possibly beyond, a concern reinforced by a wave of recent hawkish remarks from several Fed officials. Traders now see less than a 50% chance of a quarter point rate cut next month, a steep fall from around 95% a month earlier. Minneapolis Fed President Neil Kashkari was the latest to retreat from backing cuts, pointing to the U.S. economy's quote-unquote resilience and persistent inflation concerns. The news, of course, continues to pressure the peso, which has consolidated along the 59 level for the past couple of weeks. The BSP and the Fed will be announcing their decision basically on the same day, December 11 here, December 10 in the US, where we could possibly see the rate differential narrow back to just a half percentage point. So again, December may see further pressure on the peso. Meanwhile, the Fed's hawkish tone also pushed the S&P 500 last Thursday to its biggest drop of the month before Friday's sharp recovery. The recent U.S. elections saw several key Democratic wins, no, including the governorships of New Jersey and Virginia. And most notably, Zoran Mamdani's landslide victory in the New York City mayoral race over Republican candidate Curtis Sliwa. Analysts largely attribute these outcomes, no, to voter frustration over rising food prices and other cost of living pressures, which became the defining issue across many communities. Now, this prompted President Trump to provide some tax exemptions on coffee, beef, and bananas. We've all seen this strategy work in the Philippines. Now, cheaper galunggong for President Cory Aquino and cheaper rice prices for President BBM. And probably cheaper coffee will sway U.S. voters. But delving deeper into the core issue of affordability, wage growth among different classes have pressured lower income earners here in the orange line, as growth rate has recently cooled much faster than those of higher earning groups. So the convergence of all quartiles, towards the same slower growth rate in 2024 to 2025 highlights a classic K-shaped pattern that is now flattening as the labor market loses momentum across the board. Basically, while higher income consumers can still flex their purchasing power, lower earners have begun cutting back. So this creates a clear split in consumer behavior, with each group heading in different directions. Now, recent earnings from U.S. companies including McDonald's, Walmart, Chipotle, Ford, and Coke, to name a few, echo this trend, showing strong resilience in higher-end products while their budget and mass market lines continues to face mounting pressure. Now, even in the markets, we are seeing what's called K-shaped behavior, where we are seeing unequal distribution of recovery. Now, all this talk on K-shaped recovery last week in the US has revived debate over when the supposed post-COVID recession might finally materialize. And with the recent data, or the lack of it, analysts have become pessimistic on the economic outlook. So let's review some of the key indicators economists typically watch for regression signals. Here are the 5 key signs of a potential recession. You have your inverted yield curve, rising unemployment, weaker consumer spending, PMIs below 50, and falling corporate earnings. While yield curve is a thing of the past, no, we did see the yield curve inverted from 2022 to 2024. So this is 1%. This represents the yield curve inverted during that time. Now note that the yield curve indicator is a leading indicator and not real time. So historically, the yield curve inverts 12 to 24 months before a recession, then uninverts, no, long before the recession actually arrives. So in fact, in almost every US recession in the past 50 years, the curve had already moved back toward normal by the time the recession hit. So the yield curve uninverted last September of 2024. So now we are 14 months into its uninversion. So that is a bad signal, right? So in terms of job data, we've seen from our previous coverage how both non-farm payrolls and ADP numbers have been weakening in over the past 3 years. The unemployment rate shows a clear gradual increase in the number of job workers, no? And the latest data for October alone shows the highest layoffs of any October since 2003. Now, US consumer sentiment has fallen to its lowest level in roughly 3.5 years. Both current conditions and future expectations continue to weaken. So this decline directly reinforces a softening consumer demand and sentiment. Again, also shown on corporate earnings, households are growing cautious and cutting back on spending. Manufacturing continues to show a contraction, with the latest data showing 48.7 points last October. Again, anything below 50 is a contraction, and the US manufacturing sector has rarely seen growth, no, in the past 3 years. Now, meanwhile, with 91% of S&P 500 having reported their actual results. In contrast to the other indicators, earnings still show robust growth. 82% of S&P 500 have reported positive EPS surprises. So far, earnings growth is the only indicator providing some good news, with blended growth rate at 13%, the fourth consecutive quarter of double-digit growth. But take note, right, 42 companies have already warned of negative EPS guidance. So going back to our list, right, most of the classic recession indicators are already flashing red. Yield curve was deeply inverted 14 months before. Unemployment has been rising. Consumer sentiment is weakening. PMIs continue to slip below 50. So the only major signal not yet confirming a downturn is corporate earnings, which have remained resilient so far. So taken together, while the US isn't in a recession yet, the data shows it may be steadily moving closer to one. So for the US stock market, a recession means we might see further signs of volatility. The VIX actually edging higher in recent weeks, and with concerns on AI and its overvaluation, a recession could trigger a shift, towards defensives. Meanwhile, the S&P 500 again staged a comeback. Same situation last Friday to close slightly in the green. The S&P 500 closing almost 0.3% up for the week, but the local markets continue to disappoint, down 3%. Again, one of the worst performers among world indices. Now, with prospects of a potential US recession, let's look at how the US and PH markets have moved in the past 5 years. we've generally moved in the same direction until around mid 2023 when the two markets sharply diverged. While the US markets powered to new highs on the back of AI, the Philippine markets drifted lower, weighed down by the same issues, no corruption, lack of investor confidence, and disappointing growth numbers with no end in sight. I mean, last Friday's news brought the markets further down. Now, in effect, the two indices have formed their own K-shaped pattern, the US climbing steadily upward and the PSEI remains stuck on the weaker end of the spectrum. So the index suffered its fourth straight week of losses, plunging to new lows last seen way back in 2020. So bad news, guys. It looks like we could be headed to 5,400. Now, meanwhile, maybe the only bright spot is gold, as we saw gold improving to 4%. So far, gold has staged a comeback last week to narrow the gap between its peak last October. So we'll go back to how gold could perform 2 months later. Data shows there may be further sell-off, but what do we do in these turbulent times? Let's look at our trends with benefits list. Again, we double down on strong stocks and we avoid bearish stocks. And with the current situation, again, we emphasize being defensive. Bullish stocks on the left could be the stocks to monitor for now. Most stocks, especially the bearish stocks, will continue to face pressure in the coming weeks. So let's look at our screener. Now, towards the end of the year, foreign investors may start to realize their losses in order to offset their gains in other markets to reduce the tax they may owe on those gains. No? So this is called tax loss harvesting. So as our ASEAN neighbors and the S&P 500 have surged ahead of our markets, PH equities may suffer further sell-off until the end of the year as the top underperforming issues here on the screener may be further sold off to realize their losses. So we can see some names here, especially index names, no? ASEN, AC, Monde, JFC, AEV, AGI, Ali, Globe, no? UBP, SM, SMPH. Now, even on the 6-month performance, so we can see the top uh, worst performers of the PSE during the 6 months, no? DG Plus, of course, China Bank, Converge, AEV, same names, AC, BPI, GFC, BDO, SM, SMPH, Metrobank, Monde, Ali. The worst performers of the PH markets may be in line for being sold off, no, at the end of the years. But while it's not guaranteed, be prepared to see possible sell-off on these names, no, especially on the index names. So let's go to the charts for this week. Only a few stocks are on my radar. One of them, LTG. LTG now moving along this range. Looks like a good pickup. It hit resistance here at around 15. We'll see how it consolidates, but good earnings results so far for LTG. Performing very well despite the market weakness. So next we have RLC. Look at RLC, right? It has survived the market sell-off quite beautifully in the last few weeks, months, no? And has tested again the 1566 resistance. It has pulled back from its breakout point here. Let's see if it manages to bounce off of that. Could be a good entry for RLC. Some of the REITs also looking quite good. A REIT could be a good pickup at these levels. RCR also a breakout from this level. Congratulations. It's, of course, dividends have also been declared for these REITs. So next we have Asian Terminals, right? Asian Terminals bounced off of the 50-day EMA. I was looking for it to hit around 30.15, but this was a good level to pick up, especially after it bounced here. Congratulations if you were able to do so. Also, some consumer names showing some unusual resilience. We have Pure Gold. Pure Gold also showing some unusual resilience. The short-term downtrend here was broken after it bounced off of the 36 level here. Breakout, retest of this support. Let's see. Breakout, a retest of this support, right? Could see entry for pure gold, also CNPF. See the resistance here. It was support, it became resistance. Now it broke out of that resistance and is retesting that support. So monitor if it bounces. It could be a good entry for CNPF. Also, let's look at some gold plays. With gold pulling back 2% last Friday, a pullback on Apex may be imminent to around 950. Could be a good entry level if it bounces off. Also, OGP, a an imminent retest of either the 20 EMA or the 0.38 fib could be a good chance to enter. PX, however, hitting resistance here at the 0.38 fib. Let's see if it holds along the 0.5 Fibonacci level. Now, looking at the defensives, we have Aboitiz Power. So far, it bounced off of the 61 Fibonacci level here. So, I'm monitoring if Aboitiz Power could overcome some of the resistances here. 200-day EMA and the 20-day EMA could be a good chance to enter if it breaks out of that level. Manila Water also looking like a double bottom here, a breakout of this. Watch out for the resistance here at the 50 and the 100-day EMA, something to watch out for in the coming weeks. So, unfortunately, I do not have any good news. It seems like we are just moving from one episode to another, delivering bad news, markets in the red after one another. So what can we do as investors? Again, stay defensive. Make sure you have enough cash position. Lighten up on some issues that are showing weakness because some of them may show further weakness. There's no light yet at the end of the tunnel. I don't know. Maybe something as simple as the new year can bring in some renewed strength in the markets. Again, this is simply a test of patience, right? Markets have suffered downturns, bearish years, and as you know, markets always recover. It's just a matter of when. But right now, all we have to do is believe in the fundamentals, stay true to your strategy. Just enjoy the holidays. Maybe it's just time to take a break and enjoy the rest of the year and just be thankful of what we have so far this year, right? So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.